Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And you know, the recent behavior of the S&P 500 may have just opened a little bit of a window here for me to talk about taking the other side of the bull-bear equation. We're going to be talking about a bearish option strategy known as buying puts. And we're just going to be taking this from the perspective of the trader who's never really traded a long put before. We're going to be talking through planning and placing our very first long put trade. I think this is going to be an interesting discussion. We're going to be talking about stock selection, strike selection, expiration, planning the entries and exits, really the full slate of it. A lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names out there in YouTube. Hello there, Ricebird and Chuck D and Hope, Robert, Option 66, Sharon, Kevin, Josh, Greg, Eva, Richard, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. That's a great way to watch these webcasts. But be aware that you're invited to join us in live discussion. If you'd like to be here, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. I also want to let my attendees here know that my very good friend Mike Fairborn is going to be hanging out in the chats. Mike's going to be addressing any questions that I can't get to that come in through that chat function. Mike and I have been working together now for a couple of decades. He brings a ton of experience to this discussion, certainly thoroughly understands the strategy at hand. So thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody listening to follow us on social media. You can follow Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. And if you reply to one of my posts there, I try to reply right back to you. Now, similarly, you can now also follow me on LinkedIn. So if you have a preference for one of those two platforms or follow me on both, that's great. But you can find me on LinkedIn if you go to linkedin.com/in and then just throw in another slash Cameron May CS. That's my handle there. So I'd love to have you there as a follower. Same deal applies there. If you reply to one of my posts, I try to reply right back to you, and it lets us have an interaction that's not available otherwise unless the camera's on. But let's get into this discussion of planning and placing our very first long put trade. And as we do, of course, we need to consider the risks associated with trading or investing first. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right. So with that said, let's set an agenda for today's discussion. First thing that I want to do is just take a quick peek at this new development that I kind of hinted at the launch of the webcast on the S&P 500 that for some may be turning their attention from bullish strategies, maybe to start to bring in some bearishness. Now, obviously, nobody knows what the markets hold over the longer term horizon. We'll see. But I do want to take a look at the S&P 500 and use that to set the stage for a discussion of trading a put option, which is a bearish strategy. Buying a put is a bearish strategy that may allow a trader to potentially profit if a stock goes down in price. That sounds a little bit weird. We're going to talk about what a put option is, when a trader might consider buying and selling it, and we're going to plan and place an example trade before we're done today. All right, so let's go right to Thinkorswim. Let's have a look what's going on with the S&P 500. Now, not every trader uses the S&P as an indication of what's happening with stocks in general. You know, we might use some other index, but this will just serve our purposes for today. And what we might note here is that the S&P has had this great run where it's been using what was an apparent previous price ceiling as a price floor for the last 6 months. We've been bumping along above this rising price floor or support level, but just over the last, 48, 72 hours, we've kind of pushed down through that floor for the first time in 6 months and then failed to rally above it. So here's one initial premise here is for some trend traders, they may see the trend at slightly under threat here because of that broken trend. Now, not everybody uses charts. Not everybody might see this through this lens. It's just one way to see things. But another thing that is new that we haven't seen the last 6 months for a technical trader, they may note that over these two recent cycles on the S&P 500, where we sell off to a low, rise to a high, sell off to a new low, the highs are lower and the lows are lower. So for those that use that approach, that might be a second piece of technical evidence that there may be a shift in the S&P 500, maybe stocks more broadly. Obviously, time will tell. But let's just let that set the stage for this discussion. Let's say that we're putting ourselves in the shoes of that trader who thinks that price is going to go down for a while. Now, for stock investors and traders, could be a frustrating time, but for options traders, maybe we have something that can be done with this sort of information. And if prices move lower, we could theoretically benefit from that. So we're going to be buying a put option today, which is a bearish strategy using options. And the first thing that we need to do, though, is choose a stock on which to trade this put. So I've already picked one. Let me bring it up here. It's going to be Coke. What's going on with Coke, and why might a trader choose a stock like this? Well, there are some potential considerations. Let me just summarize it this way. When buying a put, the trader's just looking for a stock they think is going to go down for a period of time. Now, lots of stocks might go down. There could be a number of reasons why a trader might think that a stock is going to go down. Maybe they think the sector is rotating out of favor. Maybe they think the economic conditions aren't really suitable for that company's specific business. Well, some other considerations might be what's happening on the chart, but even before that, just because a stock is going down doesn't necessarily mean that it might be a strong candidate for a put option. There are some stocks that could go down in price, but their options are so illiquid, they're difficult to trade profitably, even in bearish conditions, even when employing puts. So here are a few other additional considerations. Number one is the trader might look for the liquidity of the stock. If we have an illiquid stock, it tends to have illiquid options, and they tend to be among those that are more difficult to trade. Number two, price per share can certainly be a consideration. What we're going to be doing is getting into a contract for the potential exchange of shares of stock. Higher price stocks carry a larger obligation or risk conceptually. So for some, that might be perfectly fine. It might be suitable for their portfolio, but price can be a consideration. But finally, what's happening on the chart might be a consideration. And in this case, here's just, one scenario for what traders might see with Coca-Cola. They might notice that over the last 7 months or so, Coke has really struggled to get above and stay above about 71.5, and it hasn't been above 72, period, since April. And it was only above 72 here on April 30th for a few hours. That stretches all the way back. When was the last time we closed above 72? That was back on April 23rd. So that might give us some interesting positioning right now. Let's say that our trader notes that, boy, we're right up against that 71.5, 72 price ceiling again. And maybe they think we're likely to go down from here. Well, how far down and how quickly down? That's going to be part of our planning as well. Well, previously, it looks like with a price ceiling around 71.5, the price floor looks like it might be down around 67.5, maybe 67.75, or in the neighborhood of 68. So let's just say that our premise here is the markets look like they may be showing some technical signs of weakness. And maybe we have this highly liquid stock. Coke happens to be one of the biggest companies in the world. So it has among the most liquid options out there. So here's this highly liquid stock that seems to be struggling against a price ceiling, and maybe it's going to move down toward that price floor. Maybe down to, I'm going to use maybe $68. I didn't intend to draw a channel here. Let me clean that up just a moment. Let me just remove that drawing. Let's switch up our drawing tool to the trend line tool. Let's say that here is that premise, though. Maybe the trader thinks that we're likely to head down. So we've sort of set the stage market conditions that a trader might look to, the stock conditions that a trader might look to, the sorts of stocks that a trader might consider for trading puts. And now let's just say we're ready to plan and place that first put trade. Okay. Oh yeah, Paul, I missed that entirely. If Paul says Coke is highly liquid, I get you. All right. Yeah, you can tell there was no pun intended because I didn't even recognize it. But yeah, nice one. Anyway, so if we think the stock is going to go down, which contract, what sort of put might the trader choose to trade? So let's move on to that stage. And as we do, the first thing the trader might consider is, well, how we figured out how far down we think the stock might go, but how long might it take to get there? And I drew this line fairly deliberately because it's fairly in keeping with previous rates of descent on the stock as it's moved down before. You notice that here, you notice that here. When the stock goes down, when Coke goes down, it tends to go down relatively rapidly, traveling down those $3 or $4 over the course of it looks like a couple of weeks. Does that make sense to you? Looks like we got close to the ceiling here, ran down to the floor there in about a couple of weeks. Same deal here, the same deal here, pretty similar there and there. And that can inform the sorts of contract, the sort of put that the trader decides to trade. So we talked about market conditions. We've talked about the type of stock. We talked about how the stock might be behaving. And by the way, if you're struggling with understanding stock charts, if you feel like you need to brush up on that, you may want to check out some of our technical analysis oriented webcasts. So we have one that's for getting started with technical analysis, which is understanding charts. There's also a technical analysis webcast series that I teach regularly on Fridays called Advanced Charting Techniques. So you may want to check that out in our calendar. But let's move on to planning and placing this put trade. Now, not everybody even knows what a put is. So let's make sure that we cover those bases. I'm going to go to the trade tab and I'm going to look at the option chain down here for Coke. So we need to make sure that we're looking at the right symbol. If it's not already here, we'll just type that in. But down below are a series of contracts that a trader might get into. And what we're considering doing here is entering into a contract where we're locking in a selling price on Coke. All right. Now, first decision is to figure out the length of the contract that we might choose to get into. There are contracts available for 3 days. They literally expire on the 21st of November. As of the recording of this webcast, it's the 18th of November. So that's only 3 days away. Well, we might get 3 days into the trade. We've run out of time and the stock is still going in the direction we want, but it hasn't gotten to where we want it to go yet. So figuring out how far the stock is going down, how long it might take to get there is going to help with this discussion or with this decision. So let's choose a contract time frame. So if we think stock might take a couple of weeks to get down to that area of price, that price floor around 68-ish, we think it's going to take a couple of weeks. If we buy a couple of weeks on our contract, that might be shaving a little bit close. And for some traders, they may double the length of time that they expect a trade to take. So let's go out here to maybe the 19th of December contracts. All right. Now we're going to turn our attention to the right side of the option chain. So we have call options on the left. We're not trading those today. We're going to talk about puts on the right. And with the stock trading around $71 per share, let me just go down this center column for strikes. And we're going to choose a price at which we're going to strike a deal to maybe trade shares of stock with someone else. Now, as I do this, let me give you a quick recommendation here. If you are not familiar at all with options, if this is your very first video on options, I'll try to cover as much as I can, but I do have a very good suggestion for you. I put together a series of lessons to take a trader from just from scratch. They know nothing about options, and then work all the way toward maybe even trading what we call multi-leg option strategies, combination strategies. You can find that on our YouTube channel. So if you're brand new to the webcast, welcome. It's great to have you here. But first thing, make sure that you're subscribed to our YouTube channel. You can go down and click on the subscribe button right now. Trader Talks is the name of our channel. And you can find our playlists of previous webcasts right here. You can also join the live streams as well. But I'm going to go to the playlist for this webcast series. And it's going to be down toward the bottom. Really, it's just second row from the bottom. So let's go all the way down here to the bottom. Getting started with options. Let's click on View Full Playlist. And with a little bit of scrolling, go back several months. You're going to be looking for these webcasts, lessons 1 through 10. That's what I'm talking about. And interestingly, look at what lesson 2 covers. Long puts, right? But yeah, work your way through those lessons if you're brand new to options trading. But let's go back here now. And let's talk about striking up a deal through a contract to maybe trade shares of our stock. So as I mentioned, with the stock around $71, I'm going to turn our attention to the strike price of 72.5, which looks like it's trading between maybe $2.40, $2.75. Let's just sort of split the difference there. And let's assume that we're able to enter into a contract for maybe $2.55. Okay. This is going to be our example trade today. Example trade is going to be what's known as a long put. Long in sort of trader speak just means that we're buying something to start a trade. Short would mean that we're selling something to start a trade. So when we hear the long, that's what we're talking about, buying a put. And specifically for today's example, we're going to buy the 19th of December. What do we say? 72.5 put. And it looks like we may be able to get that order filled. Depends. We never know for sure. But let's say we're able to do that for $2.55. Let me talk through exactly what we're getting ourselves into as I outline this. So what we're doing here is we're spending $2.55 to enter into a contract with someone else. We're paying someone else, and we want something from them. So specifically, we're paying $2.55 per share for the right to sell 100 shares of Coca-Cola at any time between now and the 19th of December to this other trader for a specified price of $72.50. In other words, we are locking in. We have the contractual right. Once this money is paid, once the contract is entered into, we have the contractual right to sell shares for $72.50. Well, what benefit is that to us? We might be able to see right away, there is an initial benefit. With the shares trading around $71, we have the right to sell those shares for $72.50. So we have a $1.50 sort of advantage on the current market price of the stock. We have the right to sell shares for $72.50 when those shares are only worth $71. But that's not what we want out of this. We don't want a $1.50 discount for which we have to pay $2.50. That would be a loser. Instead, what we'd like to see is for the stock to go down in price sometime between now and the 19th of December or in the next 31 days. Because if the stock goes down, let's say it goes down here to $68. Let's put ourselves in that future trader's shoes. Stock's worth $68. According to the terms of our contract, how much can we sell those shares for? We have the right to sell those shares for $72.50. They're only worth $68. That's a $4.50 value that we only paid $2.50 for. That would be basically, I'm rounding off a nickel, but basically a $2 profit on a $2.50 investment. That's about an 80% return if the stock goes down. Now you might look at that 80% and say, wow, that's actually quite a bit. In percentage terms, our stock has hardly even moved. It's gone from $71 down to $68. That's a $3 move. And on a $71 stock, that's less than 5%. So a relatively small percentage move on the stock has produced a relatively large percentage return on the option. A 4 or 5% move on the stock has produced around an 80% minimum, I'm going to say that, minimum potential profit if we get down to $68. I say minimum because it might be more than $2 that we make on this, depending on how quickly the stock falls. But that's it. So this is sort of an introduction to what a put is. And let me summarize that by, let's talk about why it's referred to as a put option. This is the way that I think about it. If the stock, let's say the stock does fall to $68 and we decide, hey, I have this contract that allows me to sell shares to someone else for 72.5. Let's say I decide to enforce the terms of that contract and exercise my right to sell shares for 72.5. It's like a forced sale. It's the contract we all agreed to. We went into this fully understanding what we're getting into. But I can, through a forced sale, put my shares into someone else's account, and they're contractually obligated to pay me 72.5 for that. So that's the way that I think about it, putting our shares into someone else's account according to the terms of the contract. So that is a put option, and that's exciting if the stock goes down in the time frame that we anticipate that it might move. That's not the only potential outcome here, though. So let's talk through some trade scenarios. As a matter of fact, how about let's go place this trade? We'll talk about managing the back end in just a moment, but I'm going to go to the 72.5. I'm going to put in an order to buy one or two or three. We'll talk about how many contracts we might buy. But as we do, you'll notice there are other contracts we might have chosen. Why did I settle in on 72.5? Well, that was just to start the discussion. But to continue this discussion, what if we had chosen a higher, what we call strike price, strike a deal to maybe be able to sell the shares for a higher price? That would be a better deal for us. We have the right to sell shares for $75. That's even better than 72.5. Awesome. Except it costs more to do that. So the higher price we strike a deal to sell the shares, the more we have to pay to entice somebody basically to enter into a contract to do that. Yep. Now, Jay Taylor says, why might we choose a lower strike price? Well, let's look at 70. I'm just going to use the ones that are closest so we don't have to sort of separate ourselves mentally too far from the sort of premise that we've laid out here. But let's say we enter into a contract at $70. That would give us the right to sell shares for $70 instead of 72.5. It's not as good of a sales price if we choose to exercise that. As a result, though, it doesn't cost as much. We don't have to pay somebody as much to promise that they'll buy our shares for $70 as we might have to pay someone to promise that they'll buy our shares at 72.5. So there's a potential benefit. The cost of this went down. You might think, it's only $1. It went down maybe $1, $1.40, $1.50, something like that. That is way less money that we're having to spend there. It's less than half the money to get into this deal as this deal. And that can be a big factor for some traders. Now, trade-off there being we don't get to sell the shares for as much. But if the stock were to fall to $68, this trader would have the right to sell shares for $70. They only paid basically $1 for that right, and that's now worth $2. So they might have doubled their money. So, yeah. Now, those are all ifs. Let's stick with, let's say that we've selected the 72.5. So, but the bottom line is here, the less money we spend, the less of a benefit we get for spending that money. That makes sense? If the more money we spend, the greater potential benefit, but also we might lose that investment. We have to look at that. So let's talk about how this trade might work out and how it might just completely fail. Now, I will say, regardless of the expiration that's selected here, regardless of the strike price that is selected here, each one of these puts is a low probability trade. Yep. Every one of them. I haven't found an exception to that rule yet. And that is because time is ticking by on each one of these. And if the stock doesn't move far enough, fast enough, all of these have the potential to lose some or all of the investment. So let's talk about that. Should we talk about the ugly stuff first or the fun stuff first? We've kind of already talked about the fun stuff. Let's just continue the fun part for just a moment. Okay. Hope is saying, how are you accounting for volatility? So Hope, I'm not going that deep in the weeds today. We'll park that as a discussion for another webcast. I wanted to cover just basically the basics today. But obviously, the faster the stock can move and the further it can move, the more theoretical reward it can produce, right? Obviously, that can go the other direction. But if our stock drops a couple of bucks in 31 days, is that how long this contract was? Yeah, 31 days. Couple of bucks could be good. $4, great. $8, better. The more volatility moving in the right direction, potentially greater reward. But how much is the most we can make? How much is the absolute most that this trader could make? What's the maximum gain on this trade? Well, the answer to that lies in how far can the stock move in 31 days? If the stock goes down to 68 bucks, great. We have the right to sell the shares for 72 and a half. That would be a $4.50 value. But just because I've drawn a line on the chart doesn't mean the stock has to stop going down just because it's gotten there. What if our stock were to just completely collapse? Let's say some terrible news came out about Coca-Cola. Pepsi introduced some wildly profitable product that everybody's drinking like crazy. Coke can't compete. Stock price plummets. The further it goes down, the happier we're feeling about our right to sell our shares at 72 and a half. And theoretically, the profits can continue to grow the further the stock falls until it gets to zero. That's the limit. So is Coke going to go to zero in the next 31 days? It's highly unlikely, but the deeper it dives, the more this trader can make. So there is a very large reward potential. Basically $72.50 minus the $2.50 we pay for this put, or about $70 on this $2.50 investment. All right. That's the fun side of the equation. What's the not so fun side of the equation? Well, what if the stock climbs? We thought it was going to go down. Eric says Orange Cream Coke is terrible. It tanks the stock. You know what? I've never developed a taste for colas at all. My wife loves them. I think I'm just in that category of people. It just never tasted good to me. So anyway, what if our stock ignores all of these drops and finally decides, well, you know what? This is the time we're going to break through that price ceiling, and it just goes up instead of down. And here, let's draw in a line at 72 and a half right there. Carry that out to expiration. What if our stock is up here at 73, 74, 75, and we get to December 19th? Well, now we have the right to sell shares for less than they are worth. I don't know what your math says, but to me, selling shares for less than they're worth is not a valuable thing. Matter of fact, that would have zero value. If the stock is above 72 and a half and we get to expiration and the clock has run out, time's up, the trader could lose the full amount invested. So how much can we make? Theoretically, there's a cap at about $70 on this trade. How much can we lose? Theoretically, the cap is the amount invested in the trade. And I remember worrying about that quite a bit when I first learned about options. Can I lose more than $2.50? Theoretically, no, but actually in reality, yes. Yep, we can. How can we lose more than $2.55? Well, what if our stock goes up? We lose track of time, or even if it's down. But in any case, if we're below $72, $72.50 at expiration, let's say we get to December 19th, time's up, the stock's at 72 bucks. We have the right to sell shares for 72.5, and we think, I spent $2.50 on this. I don't even care. I'm just going to let it expire. Well, actually, having the ability to sell shares for less than they're worth, there's some value, or for more than they're worth. Pardon me. We have the right to sell for 72.5. The shares are only worth 72. So there's still 50 cents of value. Brokerage firms are required to exercise those rights at expiration. If the contract is what we call in the money, having some value at expiration, it will be exercised on our behalf. And so we wind up selling the shares at $72.5. Maybe we didn't intend to. Well, now, unless we owned those shares, that trader might be in a short stock position. And if the stock continues to climb, what we need to understand, I can't go deeply into the weeds on what selling short stock shares involves. You want to study that out thoroughly before exposing ourselves to that, if we ever choose to. Just know that it has unlimited upside risk. So if we wind up selling shares that we didn't own, and those shares continue to climb, that loss, the initial loss that we took, can compound. It can grow and grow and grow. So that's the way that we might lose more than what we originally invested, and that is by allowing the contract to get to expiration and taking more losses afterward as a result. So maybe the trader might want to have a plan. If this trade isn't working out, maybe we'll just pull a plug at some point. And we're going to include that in today's example trade, right? So huge profit potential on this trade. Limited loss potential unless the contract gets exercised. That's a different story. What else could happen here? Well, what if where's the break even on this trade? How about we let's write this out. The maximum gain, the theoretical maximum gain of this trade is we buy the stock at $72 minus the $2, or not buy, my apologies. Sometimes when I type and I talk at the same time, I say things backwards. If we sell the shares at 72.5 and it cost us $2.55 for the right to sell those shares at 72.5, that means that theoretically we have about $69.55 or 95 cents that we can make on this trade. If the stock is worth $0, for example, and we're able to sell it for 72.5, that'd be a $72.5 profit, except we spent $2.55 to set the deal up. So that's the theoretical maximum gain. Unlikely to make that much. Theoretically could. What's the theoretical maximum loss? Lose the value of our contract. What's the break even on this trade? Break even is actually going to be the same as our theoretical maximum gain, the same value. It's actually the price. Let me talk through that. Let's say that our stock, which is right now at $71, what if it falls down to $69.55 at expiration? Let me clean up our messy chart here. Let me get rid of this line. Let's remove that drawing. Let's remove this one. Let's remove this one. That's where we think it's going to go, but it may not go there. Let's say that our stock goes down to just below $70 and we hit expiration right at $69.95. That's as close as I can get it. You get the point. Well, we have the right to sell shares for 72.5 that are only worth $69.55. Awesome. We have a $2.55 benefit or advantage over just those poor suckers who only can buy the shares at current market price or sell the shares at current market price. $2.55 advantage that we paid $2.55 for is break even. Yeah, break even for this trade is, again, our strike price minus the amount that we paid for the option. It's $69.55. 69.95. Today's one of those days. Anyway, Jay Taylor says, how do you decide to exercise the contract? Well, let me bottom line that. It's a good question, Jay Taylor. Exercising the contract means selling shares. Do we own the shares? As a matter of fact, in this portfolio, I don't own any shares of Coca-Cola. If I were to exercise that contract, it would sell shares that we don't have. Now, what we might do then is go buy the shares at a lower price, and maybe that would realize a gain. Most of the time, the trader is just going to sell the contract. Instead of exercising, the objective is most likely buy the contract right now while it's priced at 255, wait for that contract value to go up as the stock goes down, hopefully, and then sell the contract, not exercise it. Okay? That's usually what the trader has in mind there. And that's what we're going to plan to do today. So let's talk about managing the back end of this trade. Trade might work, it might not. So let's set up a couple of scenarios. Let's say that our trader here is hoping for the stock to go down to 68 bucks. And if it does, let's just make a plan to sell at that level. On the other hand, if the stock, let's say it starts to go sideways, the clock is ticking and it's not going in the right direction, or if the stock starts to go up and it's moving against us, both of those scenarios can start to produce losses for this put. How about let's have a plan that if our put loses, just as an example, half of its value, we're going to get out. Jay Taylor Trade says, what if you wanted to exercise the contract? What would you do? Call the trade desk. Yep. Submit a request to exercise. Okay. But let's put in two orders. One, to take out whatever profits we might get if our stock gets down to here, let's say 68 bucks. The other order is going to exit with losses. If our put ever loses half of its value, we'll just pull the plug here. It just means that the stock isn't cooperating. It's not going down fast enough. It's not going down far enough. Maybe it's even going up. So let's go place our trade. Let's go to our 72.5. There's our 239. Oh, look at this. Price has actually come down a little bit. Why has our put come down in value? Probably because the stock price has gone up a little bit since we started talking. So maybe instead of spending 255, we might be able to get this trade now for, let's say, 245 or 250. Let's say 250. Let's keep it nice and easy there. Okay? Nice round numbers. I'm going to put in a buy order and two sell orders. And here's how we might do that. I'm going to right click on the strike price that we're trading, and I'm going to put in a custom buy order with an OCO bracket. Now, what that does is it brings up a default order to buy 10 puts. If we're spending, let's say, $2.50 per share, that would be $250 per put that we purchase. This is where the trader might want to pause and think, how much are we willing to risk? How much are we willing to invest? And recognizing that all of that could be lost, how much are we willing to risk? Well, in this webcast series, we tend to try to keep that under about 4,000 bucks. So if one put costs $250 or risks $250, that might allow us to buy up to 16 puts. 250 times 4 will be 1,000 bucks times 4,000, or let's say just say 4,000 bucks divided by 250 would be 16 put contracts. How about for this example, let's just do a nice round number. Let's say 10. Let's just leave it at 10. Nah, I want to show how to change the quantities. Let's change the quantity. Let's say 5. Okay. Just make sure that our selling quantities match our buying quantities. So I'm going to click on the little broken chain link here. That links these together. So as I move away, there we go. I'll just change the field manually. Anyway, clicking on this broken chain link links these together, the quantities. So as we move to place the rest of our order, those all match. Buying 5, selling 5 under different conditions. So what are the conditions? Well, our first order, this is the one where we want to sell if we get down to 68 bucks. I'm going to make that conditional on if we got down to 68, we thought, that might be about a $4.50 value. Let's change our selling price to $4.50. If we're able to buy at $2.50 and we can sell at $4.50, we'll take our profits there. I'm going to make that a limit order, good till canceled. Limit just means this is the least I'm willing to sell for. That's my bottom price. That's my limit. The next one's going to be our stop. And stop means stop the bleeding. This isn't working the way I thought it was going to. If I paid $2.55 and it starts to move downward in value instead of up in value, let's attempt to stop the bleeding at $1.25. Attempt is a very deliberate word that I just used there. I'm going to make that a good till canceled order. A stop order, the reason why I say we're going to attempt to sell for $1.25 is a stop is not a guarantee that we'll sell at a specific price. This is just what we call a trigger price. If the value ever falls to $1.25, it kicks off a sell order to sell at the market, and that may be actually less than $1.25. But there we go. This is now a sort of round trip plan for trading puts. We're buying because we think the stock is likely to fall. If it does, we projected we should have a value around $4.50 as a minimum. So let's try to sell that if we can get that price. If it's not behaving, if instead we're losing money, we'll try to minimize the loss at or around $1.25. But let's click confirm and send. So here's our order. Buying 5 of these put contracts, offering to pay up to $2.50 per contract. That would be $1,250 total that we're spending. That becomes the maximum that we can theoretically lose. We're then going to sell those if we can sell for a $4.50 value, or we're going to sell if we drop to $1.25. Now, you'll notice this is saying, hey, Cameron, $4.50 would be great, but you can actually make a whole lot more than that. Yeah, theoretically, we could make a lot more. That would be if the stock were to go all the way to zero. Now, options 66 says you usually leave the stop trade at market. So I am placing just a plain old stop sell order. There are other different order types like stop limit order that we might enter into. I'm not going to go into those today, but usually is always up to the trader's discretion. Some prefer just plain stops. Some might go for stop limits, or there are different ways to handle this. But I'm using sort of the more direct way because this is intended to be just an introduction to trading puts. All right. But there are commissions to be paid getting into this put, getting out of the put under either circumstance, with profit or with loss. Well, let's send that order off and we'll see. We just bought 5 put contracts and we paid $2.43 for those. So the price has slipped a little bit further. So from here, we'd like to see stock price go down, but we have a plan in place in case it doesn't. All right. Lisa says, why didn't you go GTC on the long put? In other words, why didn't I say, hey, let's buy. And if I can't buy today, maybe we'll buy tomorrow or the next day. There's a risk in doing that. If we intend to buy something and it doesn't fill that same day and we have a good till canceled order, maybe it fills later in the week, later in the month. We're not even thinking about this trade anymore. We'd have to remember to come back and cancel it. So let's just do it just for the day. Now, that's not, a trader can put in a good till canceled if they want to. But guys, we have accomplished what we set out to do today. I wanted to talk through planning and placing a trader's very first long put trade. We covered quite a bit. The kind of stock that a trader might look for, strike price, expiration selection, managing the back end of the trade, as well as even talk through deciding how many contracts maybe the trader might buy. Guys, I hope this has been an interesting discussion for you. This is what we do on our Tuesdays. We talk through just getting started with options. So this will be interesting to see how this put goes, but time for me to let you go. Make sure that you're aware of all of your educational resources from Schwab. Starting with, if you are new to the channel, make sure you subscribe to the channel. Go down, click on that subscribe button right now. It only takes a second. It doesn't cost anything, but our Trader Talks channel on YouTube is where we house the playlists of previous webcasts. You can join the live streams right here. So subscribe if you haven't done that. Also, Mike and I want to let you know that you can follow us on social media. Great place to connect with your favorite presenters is on social media. So you can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. You can also find and follow me on LinkedIn now. Just started a couple or 3 weeks ago. So on LinkedIn, go to linkedin.com/in and then put in that extra / Cameron May CS and give me a follow there. If you reply to one of my posts on social media, I try to reply right back to you. Everybody, thanks for giving me your time today. Mike, thanks for helping out in chat. Thanks for everybody for clicking the thumbs up. That's always appreciated. That's like applause to your presenter. I can see that 50 of you have already clicked that thumbs up. It also gives us a boost in the YouTube algorithm, helps more people find these webcasts. All right, everybody, go enjoy the rest of our webcast through the rest of the day. I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.